Hey guys, my name is Dennis. I've been trading for 7 years and today we're gonna break down the strategy our scalp trading team uses with an average win rate over 70%. So sit back and get comfortable. In this video, I'm gonna walk you through my strategy step by step. And by the end of it, you will have a strong competitive edge in the current market. So if you want to trade intraday consistently and catch short moves, you need to stick to a clear strategy and understand where the most traders make their mistakes. In this video, I'm gonna break down exactly what I base my trading decisions on and give you a clear step-by-step framework so you can repeat my results. First, let's talk about the foundation of our strategy, because without it, everything else is simply won't work. So let's talk about liquidity. Liquidity is basically you and other traders, both experienced and inexperienced, who conveniently place their stops in obvious zones that big players can just clearly see. Imagine this: you open a BTC long at 65k, for example, and put your stop loss just below the last low, for example, let's say around 63,800. Here's a little secret: you're not only the smart one doing that. Thousands of traders place their stops in the exact same area, just below the previous highs or lows, around round numbers, or at the edge of the, for example, Asian or London range, basically where everyone sees a clear support level. The point is, classic technical analysis isn't really effective in today's market anymore, because whales and smart money can clearly see the pattern like traders are waiting for, and they go straight to eat those stops. You need to trade off liquidity, my friend, not off the little drawings on the chart that are basically controlled by the big players. Now let's break down in a simple terms how this actually works. For example, big players with positions worth tens of millions of dollars want to open a massive trade. But if they just start buying or selling at the market, the price would shoot to the moon or dump straight to the hell. And their average entry would be like terrible. That's why they need counter liquidity. Basically a large pool of ready orders they can absorb so they can build a big positions without moving the price too much. Now let's break down where this liquidity actually sits. It's exactly where all of you collectively place your stops and pending orders, namely slightly above a fresh highs, slightly below a fresh low, at equal highs, equal lows, at the edges of the previous ranges, around the open or close of major sessions, for example Asia, London, New York. A big player deliberately pushes the price into those areas. Then your naive stops get triggered, a sharp spike happens, a huge number of positions get closed automatically, a ton of real liquidity appears, and the big money can calmly build their massive positions in the direction they want, so eventually reversing the price the way they need. And that exact moment you are sitting there with a liquidation notification thinking, how the hell did that happen? There was supposed to be a support here. That's why, my dear hamster trader, understanding where liquidity sits is literally a matter of survival in this kind of market and the foundation of any profitable trader strategy. Once you can see where those zones are, you stop being food for the big fish. You start seeing where the price will most likely go to grab liquidity, and only after that make their real move. Let's move on. The second fundamental aspect of the trading is volatility. Real volatility means the market isn't just moving around randomly, it's shifting strongly in one direction. It's impulse plus displacement. When big players enter aggressively, creating structural changes and leaving clear footprints on the chart. Without real volatility, the edge goes to the market makers. You're basically just losing money on fees and gambling with a terrible risk reward. When volatility isn't there, price just chops around in a tight range, like it's couple percent in a days or even weeks, with no any expansion, no real break of structure, and no any meaningful imbalances left behind. So how actually do you identify real volatility? It's impulse plus displacement. Here are the exact signs you'll see on the chart. First of all, it's a series of aggressive candles with a large bodies and very small wicks. Price moves with almost no any pullbacks. One side completely dominates. Usually it's like 3, 4, maybe even 5 candles in a row. A fast breakout of the structure. A break of the previous high or low with a continuation of the trend, or changing of the structure. A break in the opposite direction, which can be the first signal of the trend shift. Fair value gap. Inefficiency zones where price moved too fast and left a gap between the candles with a no proper counter value. Price often comes back to fill these areas. A sharp spike in volume and indicators like RSI with the price pushing out in a strong impulse. Or for example, a sharp price spike, Usually stop hunts above equal highs or lows, round numbers or session levels, for example Asia, London, New York, not in the middle of the sideways range. If you want to learn even more about the smart money strategy, soon there is going to be a big video on my channel where I break this method down in detail and show you our indicator build around it. Make sure you subscribe. And now let's quickly go over what fake volatility in crypto actually looks like. It's chaotic price movement inside a tight range, long wicks in both directions, single spikes without a series of aggressive candles, a wick or even random volume, no break of the structure and no fair value gaps. Everything ends with the fake breakouts and quick returns back into the range, with no any real displacement and no edge for the scalpers. If you can correctly read when real volatility is present, you're entering together with the big players, right at the moment when they've already absorbed inexperienced traders and taken their stops. Without understanding how volatility works, you are simply part of the liquidity that big players use to build their positions. That's why even though we are usually open around, for example, 3-5 trades per day or sometimes even more, when the right conditions aren't there, we can easily stay out of the market for a couple of days. Back in the 20th century, one of the greatest market speculators, Joseph Livermore, said, being out of the market is also a position. And that's a golden rule in the trading, something you could literally tattoo on your hand. It's always better not to trade at all than to enter without a clear edge. By the way, Livermore wrote an excellent book, Reminiscences of a Stock Operator. I highly recommend every one of you who calls themselves a trader to read it. So let's keep going. Now we're gonna break down step by step how we enter a trade. First, an important rule: when price has already made a strong impulse, we do not enter the trade into that impulse. Why? Because entering on expansion almost always give you a bad risk-reward ratio. Your stop loss ends up being like huge, while the most of the move is already gone. If you enter like that and still catch profit sometimes, that's just a pure luck. Over the long run, it's one of the most losing strategies out there. The right approach is wait for the price to come back into the area of interest or the order block and enter from there with a confirmation. Your risk becomes much smaller while the move potentially gets bigger. Here's what happens on the chart step by step. Price first takes liquidity and makes a sharp spike above previous high or below the previous low. Then comes an aggressive impulse with a strong displacement, and fair value gap appears along with a local break of the structure. And that exact impulse creates our order block, the key zone we use to open the position. Now let's talk about how to correctly mark an order block. We take the last strong consolidation candle before the price shoots off in impulse, the exact candle where the big moves just start. But we don't use the wall candle, otherwise the stop would be too wide. We take roughly like 50% of the candle body, is like the midpoint between the open and the close. That's the most sensitive area. Plus the entire wick on the side, where the impulse later moved. When price comes back into this zone, it's called mitigation. In practice, we're only taking the most important part of the candle, the area where large orders most likely remain and where the price is most likely to react. We only trade the retest of this zone on the main time frame, for example 15 minutes or 1 hour. When price returns into the order block, we switch to the lower time frame, 5 minutes or 1 minute, to find and enter with a better risk reward to open the position. This way the zone stays small and precise. When price comes back, almost always react exactly here, not at the very edge of the candle. The stop loss goes behind the edge of the full candle with a little extra, about half or 1%. And remember, we don't chase the price when it's moving aggressively. We calmly wait until price comes back to our zone. As soon as clear confirmation candle appears on the retest, that's when we open our position. After the entry comes the most important part, position management. In scalping, most mistakes actually happen right here. You spend 90% of your effort finding the right asset and the perfect entry. And then at the very end, you ruin everything yourself by managing a great setup the wrong way. So this is very common mistake and weak spot for many of the traders. So now let's break down how to avoid it. The risk per trade must be strictly fixed. We allocate a maximum of like half or 1% of total balance per trade. I recommend starting with a 0.5% if you are not very confident identifying accumulation zones yet. That means if your account is like $10,000 and the trade hits your stop loss, you lose only 50 or maximum $100 at most. Risk control is absolutely critical. Most traders blow their account precisely because they increase the risk trying to recover after the loss, or the opposite happens. After the very successful streak of trades, which naturally boosts confidence. A golden rule in trading: If you hit a streak or the 3 stops or 3 profits in a row, just take a break. Step away from the market, from the terminal, so you don't start making emotional decisions. And by the way, a separate video about emotions and psychology in trading will be coming very soon on my channel. Make sure you subscribe so you don't miss it. Next, let's talk about how we choose the entry. First, we look at higher time frames. For us, that's the 1 hour and the 15 minutes. On those, we mark the key zones, order blocks, FFG, equal highs and lows, and the structure breaks or structure changes. This gives us the direction and the potential targets where price could move after the retest. Only after that, we drop down to the lower time frames, for example 5 minutes and 1 minute. Here we look for a reaction, absorption, slowing momentum, and structure shifts in our direction. Targets and take profits are always tied to the structure on the higher time frames, 1 hour and 15 minutes. The first partial take profits is usually like between 30 and 70% of the position, and the nearest higher time frame zone where the opposite liquidity sits, highs, lows, and order blocks and fair value gaps. This is also where we most often move to the stop to break even. We only do this after real displacement, not out of fear of losing money. The remaining position we hold toward a further zone on the 1 hour or next order block. Adaptation during the trade. If volatility fades, the move doesn't develop, price comes back into that range, or an opposite structure appears on the lower time frames, we partially reduce the position or just exit completely. Holding and hoping is the worst decision at this moment. The main goal here, don't try to squeeze the maximum out of every move. We systematically capture fast moves between liquidity zones, entry from the retest, partial take profits at intermediate targets, and exit if the structure shifts. The ability to respect risk while locking into the profits and not getting greedy is something you absolutely need to master. And that's it, guys. I've shown you what a real smart money-based scalping system looks like. One that actually works in the crypto in 2026. And the same system my team and I use to produce results like this on the market. If you're tired of burning out from stress and uncertainty every time you open a setup, getting wrecked by fake breakouts and market manipulation, spending hours on analysis and still entering trades just hoping for the best, watching others pull 50% a month while you are sitting in losses, then my approach might be exactly what you've been looking for. I'm not promising that you will trade without a single losing trade, but I can definitely show you what a consistent account growth actually looks like. If you want to take money from the market in a simpler and calmer way, trading strictly by a system and clearly understanding the logic behind every setup, then subscribe to my Telegram channel. There we share daily market analysis, break down trades, and post several trading setups each day from our team. Here's a part of our results from the last month, along with the feedback from traders who are trading with us. Everything is transparent. We show both profits and losses. If you like simple but effective approach to trading, then I'll see you in the channel. See you in the next video. Take care.